This is not a good time to be an investor or an entrepreneur. President Obama wants the official capital gains tax rate to climb from 15% to 20% next year. But the rate already is going to rise in 2013 as a result of the Obamacare legislation, which imposes the 3.9% Medicare payroll tax on so-called investment income. And to add insult to injury, the capital gains tax is not indexed for inflation. So in many cases, people are paying tax on imaginary gains. My name is Christina Sohatsky. I'm a third year at the George Washington University School of Law, and I'm doing this Economics 101 video for the Center for Freedom and Prosperity to shed light on the tax treatment of capital gains, particularly the grossly unfair practice of taxing inflationary gains. First, a bit of background so we all understand the definition of a capital gain. Let's say you earn some money, pay tax on that money, and then use the remaining after-tax income to buy an asset for $5,000. An asset can be financial, such as stocks or bonds, or tangible, like a building, a stamp collection, or some gold. To complete the example, imagine you sell this asset in 10 years, and you get 20% more than the purchase price, or $6,000. According to the government, you have a $1,000 capital gain, and the IRS will want a cut. The specific tax rate will depend on your overall income, but the correct tax rate is 0, as explained in another Center for Freedom and Prosperity video. After all, you buy assets with after-tax dollars, so the government already got to tax the income one time. But now, let's focus on the hidden tax imposed by inflation. We're going to modify the example above so that you purchased the asset in the year 2000 and sold it this year. A 20% gain may seem like a decent increase in the value of the asset, and some people will say that it's fair for the government to take 15 or 20% the $1,000 gain. But here's something they conveniently forget. According to the Bureau of Labor Statistics, inflation in that 10-year period was about 27%. So, $6,000 today is actually worth less than $5,000 10 years ago. In other words, you lost money on your investment. Yet, the IRS still wants to impose a tax. And in this example, the effective tax rate is not just 100%, it's even higher because you're being taxed on a loss. The argument for reform is strong, even if we create a more favorable example. Say you sold the asset for $7,000 and your gain was $2,000. In this case, you actually come out ahead after adjusting for inflation with a real gain of about $500, but the IRS is going to tax you on the $2,000 nominal gain. If we assume a 15% tax rate, the government gets $300. But since your real gain was about $500, your effective tax rate is actually more than 60%. And under Obama's proposed tax rates, your effective tax rate is about 100%. Back in the 1980s, Ronald Reagan protected us from inflation by indexing the personal income tax. Every year, tax brackets and personal exemptions are indexed so that we are not forced to pay higher taxes because of inflation. Unfortunately, Congress never got around to indexing the capital gains tax. Many scholars and experts have argued in favor of this reform, both for reasons of fairness and to improve economic growth. Indeed, there is a strong case to be made that the government has the authority to rule right now that the capital gains tax should only apply to inflation-adjusted gains. All you need to know, though, is that the right capital gains tax rate is 0. And if we can't abolish this unfair form of double taxation, it should at least be indexed for inflation, so we're not paying tax on both real and imaginary capital gains. I'm Christina Sohatsky. Thanks for watching the Center for Freedom and Prosperity Economics 101 video. I hope you share it widely.